Hello, everyone. Good afternoon. My name is Geraldo Olivo. I'm a certified financial planner and financial advisor at Bogart Wealth. Thank you so much for taking the time to join us today for our webinar. We're going to be talking about Social Security, and again, beyond the benefit, Social Security strategies. And the reason why the whole title is Beyond the Benefit, because there's lots of different moving parts that go into how does Social Security fit into your overall comprehensive financial plan. So thanks again for joining us. A few housekeeping items before we get started with the content. So again, welcome to Bogart Wealth. If you've been to our webinars, welcome back. If this is your first time here, welcome. You can scan in this QR code with your phone. We're always glad to meet with folks for a no cost, no obligation introductory discussion. We'd love to get to know you, see what's important to you, and see how we can help. Just simply scan in your phone to that QR code. It'll take you to a page for Bogart Wealth where you can just let us know your information and we'll have our team reach out to you. So feel free to do that at any time. And so again, Geraldo Olivo, I've been a financial advisor at Bogart Wealth. Just celebrated my first year anniversary here with the firm. I've been in the wealth management industry for close to 9 years and love working with the team, love working with our clients. A little bit about the agenda today. So we'll just dive into, what exactly is Social Security? How do I become eligible? What are the benefits? How are they constructed? How are they calculated? And then, a big question that a lot of folks have is, when should I start collecting Social Security? And then we'll have a Q&A. You'll notice there is a Q&A box. So at any point in time, feel free just to pop in your question into that text box for the Q&A, and glad to do a Q&A at the end of the session. So looking forward to answering any questions as well. Well, a bit about Bogart Wealth. We were founded in 2016 by James Bogart. We have 3 offices currently. I am talking to you today from our McLean, Virginia office. We also have an office in the Woodlands and an office near Memorial City, which is about 30 minutes from downtown Houston. We currently have about 50 plus employees. We're managing for our clients just over $3 billion, so $3.1 billion in assets under management. And currently we have just about over 1,400 clients. And again, before the Social Security part, most of our clients that we work with are individuals, families, professionals and executives that have worked at Fortune 500 companies for a long time. We also work with other individuals as well, but that's a bit about Bogart Wealth. So what is Social Security? So as of 2026, right now there's about just over 75 million people that are receiving Social Security benefits. What it comes down to is that once you get to a certain age, there's a certain tier of benefits that are paid out. Who pays for these benefits? Well, right now, for the folks that are receiving Social Security benefits, it's the people that are working currently that are paying Social Security taxes, and that is going into paying your benefit while you're retired. Social Security also covers your retirement income. There's also disability income. And there's also a separate section for income for survivors and dependents. We'll go through that in depth in a couple of different scenarios of how that works in different situations, depending on your family situation. As you know, everybody's family situation is unique. So just a little bit on how Social Security is put together and who's paying for it currently. Workers who are not covered by Social Security. So here's a couple of different groups of folks that are not covered by the program. So railroad employees, for example, some Americans working abroad. You also have student nurses and students working for college or a college club. And then, of course, children. If you're under age 18, who's employed by a parent in an unincorporated business. A couple of other groups as well. Ministers or members of religious order and Christian Science practitioners if they claim an exemption. And then another big group, state and local government employers, they may continue to exclude some employees from Social Security coverage, but only if those employees are enrolled in a retirement plan that meets federal regulations requiring sufficiently generous benefits. Now, there have been some very unique changes recently, which we'll go over, which is the windfall elimination provision and the repeal of that, but we'll go over that later in the presentation. So, how do I become eligible? Well, first, let's talk about the Social Security Fairness Act. This was signed into law relatively recently, back in January 2025. And as I had mentioned, it repeals the windfall elimination provision, also known as the WEP. Gotta love the acronyms, right? Always an acronym. And the government pension offset, or the acronym for that is GPO. What basically this says is these provisions, while they were in place, they reduced or eliminated Social Security benefits for individuals who received non-covered pension, meaning that they worked in jobs that didn't pay. Whatever they were working at, it didn't pay into the Social Security program. So what this law does, it increases Social Security benefits for certain types of workers, including some folks such as teachers, firefighters, and police officers in many states. And so with that repeal of the windfall elimination provision and the government pension offset, by those being repealed, these sets of workers in America are now able to have increases in their Social Security benefits based on this new change in the law. Also, it does include individuals whose work had been covered by a foreign Social Security system. So, again, as you work and pay taxes, you earn Social Security tax credits. And I'm going to take a swig of water here. Excuse me. So in 2026, you earn one credit for each $1,890 in earnings, up to a maximum of 4 credits per year. One thing to keep in mind, and keep this number in mind, is most people need 40 credits, basically 10 years of work, to be eligible for Social Security benefits. So you need 40 credits to get the full eligibility for benefits for Social Security. And the amount of money needed to earn for one credit usually goes up each year. And again, just to reiterate, Social Security taxes you pay are based on earnings. So the earnings that you make, that's what the taxes you're going to pay on Social Security are calculated on. So, and it's based on a certain salary cap of the amount that they'll tax you on for Social Security. So in 2026, that amount is up to $184,500, and we'll go over exactly how that's taxed. So first, let's just talk about the Social Security tax. So, and then we'll talk about the Medicare tax. So when you're working for someone else, so you have an employer, out of your paycheck, you're going to be paying 6.2% towards Social Security. That's the taxes that you're paying. And then your employer is also contributing 6.2% as well. So a total of 12.4%, half from you, from your paycheck, half from your employer, 12.4% goes in. One thing to keep in mind is that with Medicare, you're also getting taxed on Medicare, but with your Medicare taxes, that 1.5%, that is taxed on all your wages or net earnings from self-employment. So there's not a cap on that. So there is a cap on the Social Security tax up to $184,500. But for Medicare, that 1.45%, that's on any wages or net earnings. So that's just one thing to keep in mind. Also, for high income workers, there is an additional Medicare tax. So workers pay an additional 0.9% Medicare tax on income that exceeds certain thresholds. So in 2026, the threshold's $250,000 if you're married filing jointly for your tax return, or $200,000 for single filers. So just some of the things to keep in mind in terms of your overall tax projections and what you're going to be paying in for that particular year based on your income. And again, when you sit with someone from Bogart Wealth, your financial advisor, whether you're working with us as a client or you're new to the firm and we're getting to know each other, we'll do a full analysis on this data and how Social Security will fit into your overall plan. But more importantly, all the different moving parts, taxes, things such as Roth conversions, cash flow, other sources of income, putting it all together to make sure that we're maximizing and optimizing your plan based on your overall goals for your life and for your family. So what exactly are the benefits? How are the benefits calculated? Monthly benefit amounts are based on the primary insurance amount, another acronym, another fun acronym, right? PIA. So that is indexed for price inflation over time. So that primary insurance amount, that's basically the full amount that you're going to get if you had put in your full, 40 credits, those 40 quarters. So benefits are adjusted with inflation each year according to the Consumer Price Index, the CPI. And so that's one thing to keep in mind as well. And that's one thing that we track in your retirement plan analysis that we do for the clients that we work with. So let's look at the exact years for the full retirement age and how the PIA fits into that. So for a worker who first starts receiving benefits at the full retirement age, the FRA, so the full retirement age is based on the year of birth. So once you start receiving benefits at your full retirement age, you're going to be getting 100% of your PIA amount. And so for folks who were born, for example, between 1943 and 54, the full retirement age 66. And then as you can see, if you're born through the mid-50s and later, that's 66. And then the months allocated for that. So in 1957, if you were born in 1957, your full retirement age 66 and 6 months. Now, if you're born 1960 or later, your full retirement age is a bit higher, and it starts at age 67. So let's look at what happens for Social Security benefits before full retirement age. So a worker who claims retirement benefits before the full retirement age is going to get a discount on their monthly benefit amount. It's going to be reduced. So let's look at the actual chart. So one thing to look at is the percentage of the primary insurance amount that you will receive. So if we look at age 62, and that's the earliest that you can start taking your Social Security benefits, in this scenario, let's just, for an example, we have an individual. Let's assume that their full retirement amount benefit is $3,000 at age 67, and they start collecting early. So if they decide for a variety of factors, they want to start collecting at age 62, their benefit is going to be reduced by 70%. So that reduced amount that they're going to receive for the rest of their lifetime is $2,100. And again, that is adjusted for inflation over time. And it's about 5% per year increase for the years that you delay to get up to that 100%. But for example, by the time you get to age 66, 93.3% is the amount of the PIA that you'll receive, so $2,800. And then, of course, waiting to full retirement age 67, you're going to get that 100% of the amount that you're due by this Social Security program. And in this example, the $3,000. So now let's mix it up a bit. A worker who claims retirement benefits, let's look at it after. So after the full retirement age, you're going to get an 8% increase each year up to age 70. So that's another factor to keep in mind in terms of your overall financial plan. And when does it make sense based on your situation. So a lot of times I'll talk to clients and they'll be like, all right, Geraldo, what do you guys recommend on Social Security? So there is no cookie cutter recommendation. None of us know when we're going to die, and tomorrow's not guaranteed. Hopefully we'll all live a long life. And so there's so many different factors that go into it. Your overall health. What's the health history of your family in terms of longevity? What are the overall assets that you have? What is the sources of, for example, taxable income that's not in a qualified retirement account that you could utilize for your income stream after you retire, where you're paying lower capital gains tax rates by utilizing those after-tax funds, and then once you're a bit farther down in retirement, and then tapping into some of those qualified retirement accounts, such as an IRA, or perhaps, depending on your situation, you could be receiving annuity income as well. But going back to this, so for a variety of factors, again, no cookie cutter situation, but if you waited till after age 67, you're going to get an 8% increase each year. So if you waited to age 70, the percent of PIA that you're going to receive is 124% of your primary insurance amount. So the amount that you're going to receive is $3,720. So that's the benefit that you'll get for the rest of your life. If you had delayed in this situation, where at age 67, they're going to get the full $3,000 for the PIA, but then they wanted to wait. In this particular example, it'll be increased by $720. So just something to keep in mind in terms of overall planning. So let's say that, and a lot of folks that we work with, retirement means different things to different people. Some folks, it's, hey, we want to enjoy and do some traveling, see our grandkids. For other individuals that may enjoy continuing to work or part-time consulting, for example. So what happens to your Social Security benefits if you decide to say, Geraldo, I'd like to continue working at least part-time, but how does that affect my Social Security? So one thing to keep in mind, your earnings and the month you reach your full retirement age won't reduce your benefits. So that's the first item to keep in mind. And we do have a question. Thank you so much, John, for your question. And I'll go ahead and read it out loud now, and then after the presentation, I'll get to the question, but definitely appreciate you sending in the question. Questions: based on the latest news feeds due to insufficient funding, Social Security benefits may be reduced by 15 to 20% in 2034. What contingencies should I consider or analyze in my investment plan to ensure this shortfall doesn't derail my retirement? Excellent question, John, and that's something that we'll get into a little bit later in the presentation, and then I can talk specifically to that question towards the end of our presentation today. But thank you, John, for submitting that question. So in terms of, while you're continuing to work, workers younger than the full retirement age, there is a limit on how much you can earn and still receive full Social Security benefits. So for example, if you work but start receiving benefits before full retirement age, $1 in your Social Security benefits will be deducted for every $2 in earnings you have above the annual limit. So in 2026, that limit is $24,480. Now let's look at another situation. In the year you reach full retirement age, $1 in benefits is reduced for every $3 you earn over a different annual limit. In that situation in 2026, the limit is $65,160. So those are some items to keep in mind if you decide to claim your Social Security benefits prior to full retirement age. Those are some of the factors to keep in mind in terms of how that benefit would be decreased over those limits based on your overall income. So disability benefits, Social Security pays disability benefits through two programs, SSDI, which stands for Social Security Disability Insurance, and also the Supplemental Security Income Program, or SSI as it's known. Basically, a worker's entitled to disability benefits if they are under age 65 and has been disabled for 12 months, is expected to be disabled for at least 12 months, and has a disability which is expected to result in death and has completed a 5-month waiting period. So as you can tell, it's there's a lot of stringent criteria to receive disability benefits through Social Security. Federal law has very strict definitions for disability. So that's just something to keep in mind as well. Disability benefits, a bit more on that. You'll get Medicare coverage automatically after you've received disability benefits for 2 years. Certain family members may be eligible for benefits based off of your work. So, for example, your spouse, if they are age 62 or older, your spouse at any age, if they are caring for a child of yours who is younger, if they're younger than age 16 or who has a disability. And the last one to keep in mind in terms of disability benefits, your unmarried child, it also includes adopted children, or in some cases, a stepchild or grandchild. The child must be younger than age 18 or younger than 19 if they're still in high school. So again, and some of the stipulations in terms of disability benefits for certain family members as well, if you do qualify through the Social Security program. So now let's talk a bit about spousal benefits. The spouse or divorced spouse of a retirement beneficiary, they are eligible for a Social Security spousal benefit if the spouse or divorced spouse is age 62 years or older. So what are they going to get? So the benefit amount that they'll receive is equal to a maximum of 50% of the retirement beneficiary's full retirement amount, so the FRA amount. So primary worker, again, must have filed for benefits. And again, the spouse must be at least 62 for reduced benefit or FRA for the full benefit. So a couple of things to keep in mind for spousal benefits as you go through planning. And we'll talk about some of the strategies for that as well a little bit later in the presentation. So if a worker is eligible for benefits based on their own records and spousal benefits, the Social Security Administration is going to pay a total amount approximately equal to the higher of the two benefits. So, you have a husband, you have a wife, one of them from their work history is getting qualifies for a higher Social Security amount, depending on what the other spouse in terms of their work history will receive from their own Social Security calculation from their work history. The Social Security Administration is going to calculate, all right, they're going to basically pay the spouse an amount that's equal to the higher of the two benefits. And that's automatically calculated by the Social Security Administration. So spousal benefits are reduced if claimed before the full retirement age. So that's one thing to keep in mind in terms of a strategy. Let's say that your income sources, your tax situation, et cetera, and in terms of, as an example, a person-specific plan is to delay receiving benefits until age 70. One of the things that does is that, for spousal benefits, that increases the amount that the spouse could have if it's higher from receiving 50% of the amount from the other spouse who's actually claiming the benefit. So a couple of things to keep in mind on that note. There is no increase for starting spousal benefits after FRA. So a few things to keep in mind for spousal benefits when doing planning. Same-sex couple benefits, a few notes on this. Same-sex couples' marriages in all states are recognized for purposes of determining entitlement to Social Security benefits. Some non-marital legal relationships, such as civil unions, for example, and domestic partnerships, are recognized as well. The United States also recognizes same-sex marriages and some non-marital legal relationships established in foreign jurisdictions. There's a couple of nuances for that. This applies to all Social Security programs. So for example, retirement, survivor, and disability. So divorced spousal benefits. So divorced spousal benefits, It's the same as spousal benefits if, and that's a big if, so the things to keep in mind are this, someone gets divorced, what does the Social Security benefit look like for that divorced spouse? So one, the marriage lasted 10 years or more. So it'll be the same as regular spousal benefits if they meet these criteria. The marriage lasted 10 years or more. The person receiving divorced spouse benefit is currently unmarried. The ex-spouse is at least age 62. And then if the divorce was more than 2 years ago, the ex-spouse does not need to have filed for benefits. So those are some of the main stipulations in terms of divorced spousal benefits that need to be met in order for the divorced spouse to receive the same spousal benefits as if they had continued to be married. So a couple of important stipulations on that. Now, survivor benefits. So certain members of your family may qualify for benefits if you are an insured worker. Let's just go through that. A couple of examples. Your surviving spouse could qualify for reduced benefits as early as age 60. They may be able to get the full benefits at FRA or as early as age 50 if they have a disability. So again, depending on your own family situation, the ages of spouses and the family, or if there's a disability, a couple of different factors that go into when and how a surviving spouse could claim survivor benefits. Also, a thing to keep in mind, your surviving spouse may be able to get benefits at any age if they take care of your child who is younger than 16, or if the child has a disability. So some very important stipulations for receiving survivor benefits. Also, a few other items on survivor benefits as well. Your unmarried children, so kids that are younger than age 18 or up to age 19 if they're attending elementary or secondary school full time. Those unmarried children meeting those age restrictions may also be able to get benefits, survivor benefits. So your children can get benefits at any age if they had a disability before age 22. So that's from the disability perspective. So one thing to keep in mind on that note as well. So another item to look at in terms of survivor benefits is dependent parents. So your dependent parents may be able to get benefits if they're age 62 or older. So that's definitely something to keep in mind. And also, you must have provided at least half of their support in order for that to kick in for dependent parents. If they're older than age 62 and you were providing at least half of their support, then they could qualify for survivor benefits as well. So let's look at taxation of Social Security benefits this year. So Social Security, the amount that you're receiving, this is how it's calculated in terms of taxation. So let's just look at filing status. So married filing jointly, the thresholds are overall pretty low. So if your provisional income, and what the heck is provisional income? Well, if you look at the bottom of the screen, it's your adjusted gross income, your AGI, plus 1/2 of the Social Security benefit plus tax-exempt interest. So that's what Social Security defines as provisional income. So if your provisional income is under $32,000, the amount of your Social Security benefits that taxed is zero. If you're in the threshold of $32,000 to $44,000, your Social Security benefit can be taxed up to 50%. And then, of course, if your provisional income is over $44,000, then the amount is up to 85% of your benefit that will be taxed. And then it also lists the thresholds. If you're, for example, single head of household, the thresholds are a little bit different. But again, the overall thresholds are overall pretty low. The thing to remember is that, over $44,000 for married filing jointly or single head of household over $34,000 in provisional income, that your Social Security benefits will be taxed up to 85%. So just something definitely to keep in mind in terms of your overall planning. So how do you apply? So applying for Social Security benefits, you can apply up to 4 months before you want your retirement benefits to start. Social Security benefits are paid. So when exactly are they paid? They're paid in the month following the month they are due. So for example, if you are due benefits for the month of December, you're going to receive your first check in January for December. We definitely recommend applying online. It's the easiest way to complete your application at a time that's convenient for you, without, taking a trip and going through town to the local Social Security office. A couple of other methods, you can also apply by phone or, of course, in person at the local Social Security office in your area. One thing to keep in mind, you can also withdraw your application in certain scenarios. You have up to 12 months to withdraw your application for Social Security. If you change your mind, for example, you'll be required to repay any benefits you've already received. So that's a bit of a nuance, but we wanted to make sure that as we're going through our webinar today, that you had a good overview of the application process for applying for benefits. And again, I just want to note we do have another comment. Thank you so much for all the attendees and your comments and questions. For this comment, it's infuriating and confusing that we get taxed to put into Social Security, and then they tax us to use what we put in, and possible up to 50%. That's just crazy. I completely agree in the sense that you work so hard. You're paying taxes throughout your life, you're putting it into the system, and then once you're actually retired and your income goes down overall, you're continuing to pay taxes. And so it's a tough situation. It's a lot of folks don't realize how much of their benefit is actually being taxed. And so again, as Bogart Wealth, it's so important to look at, what are the tax effects? What's the overall amount that you're receiving? And then picking the best strategy on when you're going to claim benefits in terms of your overall tax structure and tax situation for your particular financial plan. So we do have another question, and thank you. This is from D. Coey. Taxed on 50% or 80% of what in your previous example? So let's go back to that. Great questions, by the way. Okay, is it 50% tax rate or 50% of the money? So it is 50% of your the funds that you're going to be receiving from Social Security. So if you're receiving a benefit, let's say, for example, the example we used earlier in our presentation today, for someone who's getting full retirement age, for example, and they're getting their full retirement amount benefit of $3,000 per month, for example, then that amount, depending if their provisional income and they're married filing jointly for that year was over $44,000, the amount that their Social Security would be subject to tax is 85, up to 85%. So it's based on the amount that you're receiving for that benefit. And then going back to your provisional income, that's really the trigger on how much they're going to tax you at. So if your overall provisional income is very low for the year, then the Social Security benefit amount that you're going to receive, so married filing jointly, for example, the $32,000 to $44,000, if your provisional income was within that specific range, then your Social Security benefit that you're receiving, that specific amount, the amount you're getting from the Social Security Administration, that amount can be taxed up to 50%. But again, if you're married filing jointly, your provisional income is over $44,000, whatever your Social Security benefit is, that amount then is taxed higher, right? Which is taxed up to 85%. So great questions. Thank you so much for the questions that we're getting in the comments. Great to have interactive conversations. Okay, great question from Kevin. Is the 85% of Social Security received, is that taxed at ordinary income rates? Yes, it is taxed at ordinary income rates for the Social Security when they're calculating that tax. So one of the things that we do at Bogart Wealth is when you're looking at, let's say that you go through we'll walk through various scenarios. look at what strategy makes best sense in talking with you and your family based on your overall plan, and looking at, all right, well, I'm going to receive this Social Security amount per year. This is the expected cost of living adjustment for the coming year, for example, because there is a COLA based on the Consumer Price Index. It'd say that 85% of that person's Social Security benefit is going to be taxed. It's going to be taxed at ordinary income rates. One of the things that we always like to do, I love to tell people this, the markets are out of our control, but one of the things that we can control that's within our power is really proactive tax planning. So if we're looking at, okay, we're receiving the Social Security benefit at this particular year, at this amount, it's taxed up to 85%. This is the ordinary income rate that we're taxed at. And let's say, for example, that you wanted to max out a particular tax bracket to do a Roth conversion. Let's say you wanted to max out the 22% or 24%, for example, as an example, marginal tax bracket to, based on your overall ordinary income that you're receiving. So calculating that Social Security tax and how that's taxed at ordinary income, and how much, if we're, for example, if we delayed Social Security benefits by a certain number of years, that would give us X amount of space to do a little bit larger Roth conversions in that particular year, for example. That may or may not apply to anybody's situation. That's just a hypothetical example, but just something to keep in mind as well. So yes, it's taxed at ordinary income rates. So yeah, great questions. Thank you guys so much for the questions. I appreciate it. It's great to have an interactive audience. So when should I start collecting? So before we go into some of the details, there's the math. We do a specific Social Security analysis report that we put together for our clients that does the math and various scenarios of how do you get the max benefit from a mathematical perspective and calculating that. But there's other factors that go into it outside of the actual, pure math, and we'll go over both. One is the income needs. Do you need the income? Have you factored in your Social Security with all the income sources that you're receiving? So for example, do you have required minimum distributions for that particular year in terms of income from pensions or annuity? What other income sources do you have? Are you working part-time, for example? Analyzing all of that, analyzing your tax bracket, analyzing whether Roth conversions or other tax strategies make sense for you that year. Or, for example, for folks that are still on receiving restricted stock units, if they're on a RSU vesting schedule and they're going to have RSU shares vest that particular year, those RSU shares are going to be taxed at ordinary income. There's federal tax withholding on those. So looking at all those various sources of income and your cash flow throughout your plan, and that's one of the kind of perspectives or focal points on determining when's the best time to claim it. Also health status. So this, again, different for everybody. Is there longevity in your family? Some folks have, relatives with their parents or grandparents that live well into their late 90s. I talked to someone recently who had a relative, their grandparent was 102. God bless them. Or perhaps, there's a different history in the family where family members have passed earlier, for example, in their 70s or 80s. And then also, how is your health? And that's something, again, as working with the financial advisor at Bogart Wealth is really, there's the numbers, there's the data. We go deep dive in all the data and analysis, but we also look at what are the other factors that are going to affect your overall plan. And one is your health. How is your health? How are you doing currently? Or what are some of the things you may be facing? Marital status, things to keep in mind, spousal benefits. For example, by one spouse delaying to the latest age, for example, to age 70, the survivor, will continue to receive the higher benefit. So that's something to keep in mind as well. And then employment status. So penalties, as we talked about earlier, do apply if you're working. and collecting benefits prior to full retirement age. So several different factors to keep in mind on when you should start. So there's a math, which we'll talk about. We'll do the analysis on how do I get the maximum lifetime benefit? What's the strategy? We'll have that document and report and data analyzed. And then we'll talk about these other factors, your tax bracket, what other income sources you're receiving, your RMDs, and then other tax planning ideas as well. Maybe it's you're doing qualified charitable distributions or making donations to your donor advised fund. All that affects your tax planning for that particular year. That's one of the things that I love doing, is putting all this together so that we're optimizing your plan in making sure that we're taking everything into account, including that taxation, which can be up to 50 or 85% based on that provisional income. As I mentioned just a second ago, this is a Social Security analysis report that we'll put together. So as a Bogart Wealth client, this is a part of your overall financial plan. A lot of good data, very in-depth, different charts, and this is part of the analysis that we'll do in terms of putting together your overall financial plan in terms of your retirement cash flow, then your overall spending goals and income being received as well. Let's just take a quick look at some of the details. And again, John alluded to this in his question. So Social Security, also known as Old Age and Survivors Insurance, again, the thousands of acronyms, OASI. So again, that is paid from the types of benefits paid from the trust fund. So you do have people paying, people that are working right now, part of that, they're paying that 6.2%. The employer is paying 6.2% up to $184,500. That's going to pay towards Social Security benefits that individuals retired are receiving now. Then you also have the Social Security trust fund. And so from that fund, plus what workers are currently earning and paying in taxes, that is funding the retirement survivor benefits. This is your Social Security paycheck. And so the full scheduled benefits are expected to be payable until 2033. And so here's one number to keep in mind. So the percentage of scheduled benefits payable at the time of reserve depletion, and I just want to clarify reserve depletion. So there is a trust fund that was set up for Social Security. That trust fund, at the time of depletion, your Social Security is going to be reduced, projected. And so here's the thing to keep in mind. By 2033, you're looking at getting 79% of scheduled benefits payable at a time of reserve depletion. And so one thing I want to draw your attention to, if there's a little bit more data, which I think is very important, if you look towards the bottom of the screen. So this is all from the Social Security Administration. That's where we're sourcing this data from. The percent of scheduled benefits payable is projected to decline to 69% by 2098. So if we're looking farther out. So the percent of scheduled benefits payable is projected to decline to 87% by 2048 before gradually increasing to 100% by 2098. All that to say is that, John, yes, absolutely, it is predicted that if nothing is changed within our current tax law, our current structure that we have for funding Social Security, the trust fund is going to run out. You're still going to get a benefit, but it is going to be substantially decreased. And in this particular scenario, from the Social Security Administration, by 2033, trust fund gone, and only 79% of your benefits are going to be scheduled to be payable. So that is a very big hit. So what are the things that will determine that? Is Social Security going to be there for me? So the bottom line, yes, the Social Security Trust Fund is predicted to run out of money. If you go back, one of the things we like to talk about is a historical context of Social Security. This isn't the first time that we've run into this situation. Social Security was amended in 1977. facing similar issues with trust fund depletion, and also in 1983. So, for example, the trust funds would have been exhausted in the early 1980s if legislation had not been enacted in 1977. It was basically raise taxes and curtailing future benefit growth. So in 1983, Congress passed additional major legislation. Part of that, increasing the maximum earnings subject to the Social Security tax. So right now in 2026, that amount that's being taxed on earnings that you're getting, whether it's from wages or self-employment, that $184,500 threshold of that 6.2% that's being taxed. Again, remember, you do have an additional 1.45% on your Medicare tax. That's in addition to that. That's for all wages. But for Social Security, one of the things they could do is like, all right, well, instead of the 184,500, we're going to increase that amount by X amount so we can fix this gap and fund this gap of this projected depletion in the trust fund. A couple of other items in terms of, from 100% of median wage income to 250% of median wage. That was part of the changes from this historical scenario. Also, the legislation introduced cost of living adjustments, or COLAs. And then if you look here, the numbers that we're referring to, they increased payroll taxes to get more taxes to fund the Social Security trust. So it went from 6% to 7.65%. So you're taking that 62% for Social Security, that 1.45 for Medicare, and you're getting that 7.65. But it was 6%. They're like, okay, we're going to run out. We got to increase the payroll taxes, and again, that was the increase on workers and employers. And then what's the other lever? Raising the full retirement age, the FRA. So originally, the FRA, full retirement age, was age 65. It was increased to 66 for those born 1943 to 1954. And as we looked at that chart earlier, this is kind of explaining some of the rationale of why the ages were increased. Well, they're trying to get more funds to pay for to fund the trust. And so then to age 67 for those born 1960 or later. So also in those amendments, adding new workers into the system, federal employees hired after 1983, all members of Congress, federal judges, etc., are included. And then the part that, and some of the comments here, which I completely agree with, is the taxation of Social Security benefits, which is a tough pill to swallow. Worked my lifetime, put in the money. Now I, worked hard, want to get the benefit, but now I'm having to pay taxes on the benefit as well. And so part of that reason, they made Social Security benefits partially taxable to fund, but this was, again, projected trust fund depletion. So these are some of the items that Congress took into effect and changes that they made to fund Social Security during those projections. So, a couple of different items. Again, you have 75 million folks who are receiving Social Security. That's a huge voting block. So what are some options for Social Security reform? Some of these could happen. None of these could happen. Nobody knows. But it's definitely worth discussing and talking about. And I will get to, John, in terms of contingencies, because outside of all of this, how can we plan for it's going to go down? It's projected to go down. How do I make sure that that projection and that, I'm projected to receive X amount, but with it, the trust fund being depleted, even though if these laws, none of these are implemented, and now I'm going to get 79% in 2033 of my Social Security benefit, how do I make sure my plan is still successful? I'll talk about some of those strategies in just a second. I haven't forgotten about that. But some of the options for Social Security reform, that's a great thing. Yes. How can we get a lump sum? Lowell, that would be very nice to get it up front, and then we can have the funds now versus later. That's a great comment. How can we get a lump sum? if you never know what they'll pass, but here are some of the ones that have been kind of kicked around. Increasing the maximum earnings subject to the Social Security tax, increasing the full retirement age, increasing the early eligibility age, which is set at age 62. Reducing the cost of living adjustment. So, every year your Social Security benefit gets a kick tied to the Consumer Price Index. Well, they could reduce that. Changing the benefit formula on how it's calculated on some of the calculations that we went over earlier. Increasing benefits taxation. And again, it's already high, with that up to 50 or up to 85% of your Social Security benefit amount that's taxed depending on your provisional income. They could decide to increase that as well, or increasing the overall tax base. So these are a couple of different options for Social Security reform. Again, the huge voting block is 75 million people. But one of the things that I like to tell clients is, as we're working through their plan, is planning for contingencies, because none of this may happen. We don't know what will happen, so let's plan for contingencies. And so before I go into other tips, I just want to address from John's question. So what things can I do, or how do we consider and analyze in a person's investment plan to ensure this shortfall doesn't derail their retirement? So a couple of things to keep in mind. When we put together a retirement cash flow plan and we look at all sources of assets, all liabilities, we take into an account inflation, we take into account taxes, we take into account whether we're going to do various tax strategies, for example, like Roth conversions over several years to get more of a tax-free bucket. But looking at your Social Security income and then running scenarios of, okay, this is your cash flow plan. If let's say, for example, that it goes to 79% funding in 2033, let's stress test the Social Security income amount in your plan based on these projections. And again, that's if nothing happens, but it's good to walk and stress test the plan. So I would make it analogous to this. We'll run the plan based on, okay, Geraldo, reduce my Social Security benefit by 50%. It looks, things don't look good. How will my plan work? How is this going to affect my cash flow? How's it going to affect my tax brackets for that particular year? And will I still be able to have the lifestyle that I want? And again, Social Security was never designed to fund the full, replace all income for a worker. There's other areas, right? Savings, 401k, pension, etc. But it is a very integral and important part of a financial plan. So stress testing that. Well, what if it went down, reduced by 20%? What if it was reduced by 50%? And stress testing that, looking at how does that affect cash flow? How does that affect overall spending? And taking that into account, how does it affect your overall tax planning? So that's why it's, we meet with our clients on a regular basis, stress test various scenarios for Social Security, because one, there's the mathematical equation of that report, but then there's also the other factors of health, if you're working part-time, spousal benefits to consider if you wait, but also going back to, hey, we don't know what's going to happen. Let's look at worst case scenario. Does my plan still hold up? Am I going to be able to pay for everything that I want to when we first got together, or do any adjustments need to be made in advance and do some proactive planning? And that's a part of the process that we always do at Bogart Wealth. One of the things I love to do is how can we be proactive in looking at, all right, this is to be expected. This may or may not happen. It looks like that, if they don't take any action in Congress, it's going to be depleted. How can, by that certain amount to, for example, 2033 to 79% of full benefits that are being paid, how do we plan for that? What are the contingencies? And so those are the things that we'll put together, John, in terms of working with our clients and going through those scenarios. One analogy is, when we put together your investment portfolio, one of the things that we do is stress test the portfolio through various market conditions. The market's going to go up, it's going to go down. It has its cycles. That's to be expected. But one of the things that we want to do, of course, is be proactive and let's stress test the portfolio. So based on your risk tolerance, your goals, your overall spending, your overall income sources, life expectancy, legacy that you want to leave to your children or grandchildren, for example, different for everyone. But for your specific plan, let's stress test that portfolio. We'll run 1,000 randomized trials on various market conditions to see how your portfolio stands up. And at the end of the day, after that stress testing, what's going to happen to my overall plan? And will I be able to meet my goals, or do we need to make any adjustments? So same thing with Social Security in terms of, stress testing those various income amounts received from Social Security based on potential reductions, and running through those scenarios in a proactive way in your plan. So thank you again, John, for that excellent question. Great questions from everybody. I really enjoyed our conversation and interaction today. So just quick, before we wrap up, just have a few minutes. A few other tips in terms of Social Security. So if you go to the Social Security Administration, they can estimate individual benefits. They're going to tell you exactly the amount that you're entitled to now based on your earnings. What they cannot do is project future benefits through scenario planning. They cannot help with innovative strategies designed to maximize your benefits. So some of the things that we talked about today, for example, in terms of stress testing and going through your financial plan with your advisor. Another thing to keep in mind, some of you may be familiar with this, the file and suspend was eliminated in 2015, deemed filing. So before 2015, you had some spouses that collected spousal benefits, but also were letting their retirement benefits grow. So now this is no longer allowed. So a worker who's eligible for both spousal and also eligible for retirement benefits must receive a combination of the two benefits that equals the higher amount. This is not a calculation that you're doing. The Social Security Administration will calculate this and will pay out that higher amount based on that calculation. Also, Medicare Part B, for those folks who have not started Medicare yet, one thing to keep in mind is Medicare Part B will automatically be deducted if you start Social Security after 65. So those Medicare Part B premiums will be automatically deducted from if you start Social Security after 65. So that's one thing to keep in mind. Here, Social Security Administration Form 44, if you want to appeal an IRMA for a qualifying event. Well, what is IRMA? All that is another acronym for, guess what? More taxes. And so this is something that we also do very deep tax planning on, because that's one of the things that we control. So one thing to keep in mind just on this quick note, because it all goes together. When you're receiving, so let's say that in one particular year, you're claiming Social Security, you're getting income from various other sources, and you have a certain amount that comes out to your modified adjusted gross income or your MAGI. So that amount, so what the Social Security system does is they look at your modified adjusted gross income from 2 years prior to the current year. Based on that amount, they're going to, all right, if your income was high and over certain thresholds, you're going to have to pay additional premiums on your Medicare premiums based if you have a higher income. There's certain thresholds for that. Lots of nuances to that. Sometimes it makes sense because of overall Roth conversion strategies. We look at your lifetime. How do you optimize your tax planning over your lifetime and pay the least amount of taxes? We do that deep dive analysis so that if you're having to pay IRMA, but overall your lifetime tax analysis is lower based on what you're doing, for Roth conversions, for example, it may or may not make sense, but we'll do that analysis for you. Okay, last question here. Thank you, Denise. Look, we have two more. Kathy, I'll fit these in. Kathy, if you're already getting Social Security and they decide to raise the age, will it take away will it take away if you're younger than the new age they raised it to? Great question. From my understanding, if you're already getting Social Security and they decide to raise the age, and you're already receiving that amount, from a voter, government standpoint on the laws that they pass, I think you'd have a lot of people very upset that they've been receiving a certain amount, and that now it's been changed because the age has been changed by the new laws, for example. So, more than likely that's just going to be for future workers. But it all depends on what the laws at that particular time would state. But you'd have a lot of upset voters if they were to do that. But thank you very much, Kathy, for that question. And then Denise, thank you for your question. Does the file and suspend include the spousal survivor benefit? So if you start collecting at 60, can you delay your own Social Security until age 67 or 70? Denise, that is an excellent question. For that one, I'd definitely like to just follow up after the seminar. I can tell you just in general, so with the file and suspend and including the spousal survivor benefit, so if you start collecting at age 60, can you delay your own Social Security until age 67 or 70? So one of the things, up front, if you're going to be collecting, if you're going to be collecting the spousal survival benefit, that's if you're starting to collect it, you have to follow those rules we discussed earlier, but that's when you're going to be receiving the benefit. So if you're receiving the spousal survivor benefit, delaying your own Social Security, that's something I definitely want to get back to you on, Denise. If you put that in that QR code, I'm glad to just double check on that and get you that specific answer for that question. That's an excellent question. So again, thank you everyone for the interaction and questions today. So one thing just to wrap up, qualities you might consider in selecting your advisor. So definitely you want to talk to someone that is a certified financial planner. So for example, I myself am a certified financial planner. Advisors at Bogart Wealth are certified financial planners. You want someone that knows your retirement plan, someone that knows the IRS retirement rules. Also, someone who's navigated multiple business cycles, someone that manages portfolios. Also, someone that's open to discussing various strategies, providing financial planning based on your needs and risk tolerance. At the end of the day, it's someone that's knowledgeable, that's highly certified. The certified financial planner designation is really the gold standard for financial planning, and that really knows the world that you're coming from. So in terms of a lot of our clients from Fortune 500 companies, maximizing benefits, mitigating taxes, and aligning that with your overall financial plan. Also, you want to make sure that you're getting regular portfolio performance reporting. And then also all the other strategies that go into a financial plan for our clients. So again, thank you so much, everyone, for the great interaction today, the great questions. Denise, please do reach out to Bogart Wealth and ask for me, and I'm going to get you that specific answer relatively quickly. Excellent question. I just want to make sure I give you the exact right answer on that because there's various nuances. So thank you again. Please click on this QR code if you'd like to talk to any of the advisors at Bogart Wealth. We'd love to meet with you, see how we can help. And if nothing else, you'll get some very helpful data and information and recommendations based on the data that we go through together with you. Please join our additional webinars and seminars. We do have them on a regular basis. Check out our website. We do have a podcast, lots of great information. We believe in educating folks on all these different facets of financial planning. And I hope everyone has a great day. Thank you so much.